what's surprising is the size and speed of this decline. It does seem like a flash crash.
Yes, no, that's right. Yeah, thank you for having me on. I think for Taiwan market, the factor for that, this market this year has seen a surge of retail buying. Usually it's about 50% of trading volume. It's moved up to about 70 to 80% this year. And really that's a function of the last couple years has been quite well for Taiwan. It's been one of the strongest markets. We've had a good tech cycle, and on the back end of that, you've seen a good surge of buying. But then I think what's happened, we've largely been spared here of COVID-19 from the worst of the impact. And in the past week, really for the first time this epidemic, we've seen the community spread. Right now, still a handful of cases, where yesterday it was in the range of 6 or 7 cases. But it's sparking a bit of fear that it's the first time they've really been undetected where the spread came from. And so there is a fear it could begin to spiral to bigger caseload. The government's taking stance to try to control group activity and may tighten that further. So I think that is triggering some of the move in the market now where, for the first time, really COVID could hit home here.
Put that in perspective for us, Randy. You talk about how it's sparking a bit of fear, but these are such massive moves. And these companies were darlings of investors. I mean, what's really changed?
Yeah, I think so. I'll kind of say where the tech cycle is. We're still in a place of good strength, like just from some of the demand drivers that have been doing it. We're really not back to full reopening, so a lot of that consumer home demand, PC demand is still there. And you still have those ongoing, the cloud demand and 5G. So that part, you could say, is still similar. Now, where we're at, though, because things have been so strong, you do have a lot of skittishness about concerns about peaking metrics. When things are quite strong, can it get any better? So even in recent weeks before COVID, there's been a bit of profit taking. Now that we're getting through some well-expected good results, and so you're in a bit of a lull post the peak of results season. I think to calm markets down, it's ultimately I think two things really: the COVID, if they can contain it like they have before. And second, as we start to get toward mid-year and into third quarter, a reassurance really that we haven't really peaked, that we could have the stronger for longer cycle.
Randy, I was just throwing to Yvonne about this. I mean, is it a perfect storm? We've got the same geopolitical issues playing out. Taiwan is right at the center of these tensions at the moment between Beijing and Washington. On top of that, you mentioned those restrictions with regards to COVID. Then we've got semiconductor problems. And on top of that, we had a tech sell-off in the US last night. So give us a sense of which way this is likely to end up.
I think for a short-term correction, it is the perfect storm that you just have, like you mentioned, a few events playing out. You've had strong interest, strong outperformance in the market, the first signs of COVID, a bit of global skittishness, and that couples with what you're seeing. It's a tech-heavy market, and you've seen that kind of shift from growth toward value. And so that puts it from kind of some of the COVID winners, which already you're seeing a bit of profit taking. Add on top of that, May, it's tax month here. And so you normally in a market where you've had a lot of retail, you get some selling, a typical sell in May, but a bit of that activity as well on top of it. So in that way, in a short term for a pullback from the strength, I think a few factors do play into it to trigger a bit of a correction. Along with what you mentioned, the geopolitical, there have been some headline stories from economists and other publications about geopolitical, where I think it's still not the imminent concern on the ground here, but it does draw some attention to the market in the middle of that.
Randy, do you think that people in the States and elsewhere in Europe will be looking at this and look at what they are likely to do with semiconductors? In other words, very shortly, is there likely to be a spillover?
Yeah, I think from that, I mean, for the semiconductor activity, we're seeing the big picture pieces as far as U.S. Europe trying to put more funding on the ground. From a capacity and building up fabs, because it takes so long to get to actual construction, that point is more multi-year phase. And so you'll continue to see those activities like Intel, TSMC, Samsung announcing some capacity in U.S. But ultimately for global shifts of capacity, it's just much longer running. inaction. I'd say still from customer decisions, it also happens relatively slowly. Their main consideration really is getting the best product out at the best cost on time to market. And so that's why even those purchasing decisions happen more gradually as well.
Randy, very quickly, you talk about it being possibly a short-term correction. Any reason to be buying the dip?
Yeah, I mean, my take, I think as we get into June, July, what could be the buy on the dip, there still are a couple good trends for tech, which are more multi-year in nature. 5G, we're still just second-year penetration. The cloud compute is still there and still healthy. And we're talking all about the auto shortages, but we're relatively early in auto industrial markets coming back. So I do think from resilient tech space on a pullback, and also you can say some of these companies in Taiwan, the leading tech companies, are still in a good position. So if we take some of the foundry design companies or ODMs, still in a good position to benefit from that. So I do think on the dip, we get a pullback through these couple months lull. We could be looking at heading into mid-year and second half, room to buy into this weakness.